This week on the Retirement Quick Tips podcast, I'm talking about how to handle stock market corrections. Today, I'm talking about what you can do specifically if you're looking to protect yourself. Hopefully, if you've been listening earlier this week, I don't want to convey the message that you should put everything in cash. No, that would be a huge mistake. We want to maintain our long-term focus and have the right mix of stocks and bonds for your age, your stage in life, your risk tolerance, and not let distractions cause you to make decisions that are outside of those bounds. So too much in stocks is a problem if you're close to retirement. Too little stocks is also a huge problem. So we want a Goldilocks scenario here where you have the right mix and you're doing the right things within those various mixes. So in order to help protect yourself, there are certain things that you can do to ensure that, I'm assuming you have the right mix of stocks and bonds, not too much, not too little. Once you kind of get those big check boxes ticked off, then you can drill down to some more strategic things that you can do to further protect yourself. So what I mean by this is, first of all, you don't want to have more than like 5 to 10% of your total portfolio in cash. If you have too much in cash, or even like money markets or short-term CDs, those are paying pretty good interest actually, but they tend to be variable rates, and long-term, it's just not a good idea to have that much money in cash because inflation and taxes just suck it right up. But within that, I would recommend increasing your money market and your cash holdings so that you have plenty of cash, especially if you are retired. You have plenty of short-term liquid assets available through cash, money markets, CDs, etc., that you could pause your withdrawals. If you're already retired and we do enter a bear market, pausing your withdrawals for a period of like 12, 15, 18 months would be amazing. And it's very important to protect yourself on the downside. So having enough in cash so that you could pause those withdrawals. There's other things that you would want to do as well, like maintain some flexibility. I would take a pause on any major expenses this year simply because I wouldn't want the outflow. I'd rather save the cash. I'd rather not make big, huge, permanent changes unless I absolutely had to. If you're planning like the trip of a lifetime, I don't know, maybe next year or something. So preserve some cash, maintain some flexibility so that you could stop your portfolio withdrawals if you are already retired. I would also invest in some more safe havens. So I talked about rebalancing if you have an overconcentration to stocks and some of the riskier assets. But the question is, well, what do you do with the proceeds? If I rebalance and sell some of those stocks, I want to put them into CDs. I like CDs a lot right now. They're still paying quite high interest rates and they have the FDIC insurance. You don't have to get them only through your bank. Most financial institutions, you can buy brokered CDs from a variety of institutions across the country, all in one account. So there's lots of options when it comes to CDs. Similar to that would be like high quality, short, intermediate term bonds. You could do corporate bonds. You could do treasury bonds. I'm not a huge fan of treasury bonds because I don't think the additional protection you get is worth the trade-off. Is better with corporate bonds because the rate is better. And as long as you're diversified and smart with the types of corporate bonds you're making, generally, especially if you're investing in funds or ETFs, corporate bonds are very attractive as well, especially on the short, intermediate term. And then, of course, if you're wanting to stay in stocks, I think a lot of dividend stocks are looking really attractive right now. There's lots of safe havens, even within the stock market itself. Like you don't have to get out of all of your stocks. I'm not suggesting that at all, but you could reallocate some pockets of riskier assets that you might already have in the stock market, put it into different stocks. To expand on this a little bit more, not all bear markets or major corrections or downturns are alike. Most of the large stocks that make up the S&P 500 right now, they have been unloved and cast aside in favor of the biggest tech darlings. I actually first pointed this out. The over concentrations in the big tech names in the overall stock market, wait for it, I talked about it in 2018. I talked about this on my YouTube channel. So it's there. There's proof. I talked about the hidden danger of index funds. That's what the video was called. Unfortunately, it was like, I was probably like the third or fourth video I ever published on my channel. So I think like 350 people have seen it in the 7 years that it's been up on YouTube, but it's there. And I was talking about this 7 years ago, before any of the parabolic run up that has happened since then. That was 7 years ago. The concentrations have only worsened in the indexes. So if you're looking at the S&P 500, the largest tech names, the largest holdings, if you look at just the top 10 holdings, because it's a market weight index, something like, I don't know, 30, 35%, somewhere in that range. It's just the entire 500 company index is just in those like top 10 holdings. So it's not as diversified as it once was. But the good news is that if you do not have an overconcentration in tech stocks, there are plenty of great stocks out there right now that are not overvalued. In fact, they look pretty attractive. These are companies that have low debt, they're well managed, and many of them pay growing, consistent dividends. Lots of companies out there match this criteria. Whether you're looking to reposition out of stocks altogether, or maybe just reduce some of the riskier parts of your portfolio and reducing some of the concentrations that you might have, especially in overvalued areas like a lot of the tech names and tech stocks right now, there's lots of opportunity to move into some safe havens, beef up your cash, increase your fixed income or bonds, CDs that you own, and kind of reposition your portfolio for good times and bad times alike. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.